It's my favourite time of year. What you need to know ahead of this earnings season.
Margins have been massively down across all of the big names that have come out so far and sort of confessed that their earnings aren't going to be as good as they possibly could have been.
One property company due to report reveals how it's managing those higher costs.
Talking double-digit rents. We're going through rent reviews at the moment that are seeing 20 to 30% increases.
It's Monday the 14th of August and you're watching Markets with Madison. The next few weeks are the busiest in the business calendar, and investors, you have to pay attention. These are all the big companies that are reporting financial results this month. Take a screenshot if you need to. This week we have Fletcher Building, Spark, Contact Energy and ScalaUp. The next week is huge. The ones that are closely watched are Air New Zealand, Auckland Airport, A2 Milk, Sky City, EBOS Group, Sky Television, Michael Hill. Also power companies Mercury, Genesis, Chorus and Vector, and a little bit of transport with Freightways, Port of Tauranga and some property in the mix too, including Precinct and Somerset. To finish it off, restaurant brands Meridian Energy, Tourism Holdings and Vulcan Steel. With so much on the agenda, what should you be looking out for? Well, Mo Singh from Craig's Investment Partners is here to tell us. Hey Mo, how are you?
Hi, good to see you, Madison.
Yeah, you too. Who are you keeping your eye on this earnings season and why?
I think it's going to be an interesting one because we're going into it at a time when the Reserve Bank is actually trying to slow the economy down. So it's kind of keeping an eye on everyone, to be honest, in terms of the outlook statements in particular. Lots of our companies have been pretty resilient through the last few years with COVID. Lots of them have shifted their sort of cost bases and things like that to prepare for any further hiccups, and those hiccups are now coming. So I guess the interesting thing we've seen is that the confessions that are coming out so far are very much what you'd expect in terms of those sectors. So they are in that discretionary retail, in that construction sector, which the Reserve Bank will be happy to see because it shows that in the real world, what they're trying to do is actually working. But we haven't seen a lot from a lot of our quality defensive names, which is exactly what you'd expect as well. So I think for those names, the defensive quality, big caps in our market, it's really just about how cautious are they going to be on the outlook statements rather than is their result going to be really, really poor, because I don't think it will be.
What are the main issues that you think could really be hurting their finances? Higher costs, higher rates, what else?
Yeah, absolutely. That higher cost is a massive one. All the downgrades, even in that discretionary side that we've seen, haven't necessarily been, huge downgrades in terms of the sales. So the sales are still coming through, but the margins have been massively down across all of the big names that have come out so far and sort of confessed that their earnings aren't going to be as good as they possibly could have been. So I think that's where most of the pressure is going to come. Over the last couple of years, you've seen I guess consumers have been willing to just accept that prices are higher, so they've been willing to pay higher prices. I think that theme is coming to an end now that, you and I are getting hit in our back pocket with interest rates rising, and the cost of food and cost of living. So I think the decision making has changed over the last 6 months for consumers, and there's a lot more sort of conservatism, and that's starting to flow through, that you're starting to see in some of these earnings outcomes. And remember, those businesses have employees, those businesses have debt. So all of those costs that you and I are seeing in our everyday, the same costs are starting to flow through to what's happening with those businesses, and it's sort of coming through in those earnings downgrades and some pretty big share price moves.
We've known that the good times are coming to an end for a while now. So how sure are we that we're actually going to see some pain this earnings season, or could it still be delayed?
Yeah, it's a good point, isn't it? Because I think if you had this conversation at the start of the year, we would have said the pain's imminent, Madison. But, we're now 8 months down the track and it still hasn't kind of arrived. And that's been the real surprise. And I think the risk there is that the market, because the pain hasn't arrived that was expected all year, we could get into a bit of a false sense of security of, hey, maybe the Reserve Bank will pull it off and maybe the pain won't arrive. I think it will. I think it's delayed, and the second half of this year, we're expecting more volatility as some of the impacts of those higher interest rates and some of the tightening that the Reserve Bank is asking us all to do as that flows through in the second half, I think it certainly will arrive. The nuance with the New Zealand market is lots of our companies aren't really exposed to, the man or woman on the street. If you think about the electricity companies, it doesn't really matter if you or I feel poorer or richer, we still pay our power bill. Same with the telecommunications company. We won't cut off our internet, we won't stop paying our phone bill. We'll make adjustments, might not go for an extra coffee, might not go on a holiday, might not go to the restaurant, but those sort of non-discretionary items that we spend money on, I think will continue. And that's what we try and remind our clients to remember, is the electricity companies, those big, stable, cash generating businesses, nothing's going to change for them materially. It's the ones that are a bit more discretionary exposed in construction, retail, and you're seeing them come out of the woodwork already. Those are the ones that I think will continue to hurt if and when that hard stuff arrives later this year.
Hit me with some names that you're going to be keeping a very close eye on, Mo.
I think in New Zealand, if we think about that expected slowdown, then we don't have too many bellwethers for the economy. Trade Me used to be one until it disappeared off our market. But I think probably Port of Tauranga and Freightways are two key ones that I will be keeping an eye on, not necessarily because I think they're going to have really bad or really good results, but they're a good proxy for how things are going. Freightways moves, 40% of our parcels, big market share. So if they're seeing that volume translation into slowdowns, then we know there's really a slowdown happening. And Port of Tauranga, big part of our economy in terms of exports and imports going through that asset. So those two I'll be keeping a close eye on, because I think they'll give us a lot of insight into how New Zealand Inc is performing. And you see the commodity side, whether it's the milk price payout coming down, whether it's all the weather events and things like that, that's going to have an impact on our exports and the volume. So the port's result will hopefully indicate that, as will Napier Port. But those are two I'm keeping an eye on from a New Zealand Inc sort of point of view. And then I guess the electricity companies is always interesting. I don't think they're ever going to surprise you. And if they do, then something's gone horribly wrong. But they're in a great position. The government wants to get closer to, carbon neutral. We want to see more renewable generation. All of that paints a pretty good backdrop for that sector. And you've had a lot of rain. If you're in Auckland, if you're in the Bay of Plenty, if you're anywhere in the country, it's felt like it's just rained for a long, long time. Maybe not so much in the last month, but lake levels are really high. There's lots of fuel in terms of water to go through those hydro generation assets that those companies have got. So I expect them to have solid results, and the outlook will be business as usual for them. So they'll probably perform pretty well.
Best of luck with it, Mo. See you on the other side.
Excellent. Thanks, Madison.
One company that's due to report this month is Property for Industry. It's a commercial landlord that leases space to big businesses like Mainfreight, New Zealand Post and DHL. So its Chief Executive, Simon Woodhams, has a pretty good read on the economy. Simon, thanks so much for doing this. Good to see you.
Yes, nice to meet you. Thanks for having us.
Anytime. You are effectively on the front line of what I like to call the real economy, the industrial economy, things that are being made, real hands-on products. Given that, what are you hearing and seeing in that side of the economy right now?
Yeah, it's a good question. We like to think we are the bellwether of what's going on in property. We've got close to 150 tenants across a wide range of industries. So as you said, manufacturing, construction, exposure to logistics, storage. In general, it's pretty buoyant is what I would say. There's obviously cost pressures coming through. Labour being a really big one for our tenants. But the general feedback we get at the moment is people are preparing for tougher times. I think there's a real understanding that there's probably a little bit of hurt to come through, as demand sort of falls off towards the back part of this year. But currently, we're in a pretty good spot, is what I would say. And most of our tenants seem to be weathering it pretty well.
What does that mean for PFI? Because you are a long-term developer, especially with these tenants that you've had for a long time, right? So are you looking to push rent increases through to them, or are they just perhaps not looking to develop as much longer term?
So we've got a $2 billion portfolio, 94 properties spread mainly throughout Auckland, 85% in Auckland, the balance around the country. So we are a long-term owner of these assets, which is really good. It gives us the ability to work with our tenants on long-term issues and come up with solutions. In terms of rents, there's no doubt in the industrial sector it's really pushed through in the last 12, 18 months in particular. Talking double-digit rents. We're going through rent reviews at the moment that are seeing 20 to 30% increases.
Wow, and they're happy to pay that?
No one's happy to pay more, but I think there's an understanding that if you're in a building that's under-rented, there comes a moment within a lease that you have to catch up to market. So for a long period of time, I think the last 10 years, rents probably averaged about 2% per annum. And with the rise in land costs and construction costs, that was never going to be sustainable. So big lift in CPI that's flowing through. And bear in mind, quite often the rental portion of a tenant's cost basis or cost pie might be as low as 8 to 10%. So it's an increase in that part, but the wider cost pie is being worn, I guess, around. Labour's probably the big cost that's really jumping up for a lot of these guys.
Imagine from what you're telling me from this that your tenancy rental agreements, they're not tied to inflation, so you're playing catch up there?
A real mixture. So about a third is tied to CPI plus a margin. So again, go back 5, 6, 7 years ago, those rents were probably going up 1-2% per annum. Obviously, with what's happened in CPI, we're having a day at the moment. Some of them are going up 6-7%, which is a big increase. And then 2/3 are tied to either market rent reviews, so on a periodic basis, what's going on in the market, you're exposed to that, and then fixed reviews, anywhere from 2 to 3.5% on an annualised basis. So yeah, I mean, our average lease term's 5 years. So if we sign a lease that might be 10 years, for instance, you typically have annual clickers on the way through and then a mid-market review at year 5. So no one wants to be under or over by 10, 15, 20%, but occasionally that happens. And what's happened in the market in the last 12, 18 months is market rents for industrial property in particular has really driven ahead.
So if you're hiking rates by that much, are your tenants then looking to lease less property with you? Do you think that there's a risk that they then go, okay, we're not going to grow as much as possible and take more logistics, warehouse or distribution space, given how costly it is?
That's something the tenant's always looking at, is the premises fit for purpose? And I guess what our portfolio, we've been around since the early 1990s, so it's some of the property we've owned for a very long time. It's generally really well located, so you're close to motorway, on ramps and exits. Generally, they're generic buildings, so if a particular tenant wants to grow, they'll move out into another one of our bigger buildings. If they want to contract, we try and have a smaller building for them. So there's the ability for tenants to grow and contract, but it's a big decision for a tenant to move. There's a lot of cost involved in that. Current occupancy rates in industrial property in Auckland in particular below 1%, so there's not a lot of options out there for them, so they have to think really hard about how do they maximise the premises they've got, and that's where a good landlord can come in and help. They can add additional space, perhaps build a canopy and make it more fit for purpose.
I guess those tenants need to have a pretty robust forward outlook of what their earnings potential looks like, right? To move into a new space, to develop potentially a new site with you. Are you worried then about the pressure on earnings given the economic environment that we're in and what that might mean to you as a landlord?
We worry about the pressure on earnings year in, year out. We're charged...
Not yours though, if you're charging 20% more.
Yeah, but our cost basis has moved up. Interest rates have moved up sharply. So, we're a company that's there to deliver growing returns to our shareholders. So we think about it all the time, just like any business. So, whether you're a tenant of ours or not, most people will have a 3, 5, 10-year plan in mind. So we're in a part of the cycle with interest rates rising. That does put pressure on us around earnings. We're probably fortunate that 4 years ago we chose to get out of everything but industrial and return to our core focus of industrial property. And right now industrial property is enjoying some really good rental growth. So that's protecting us a little bit around that interest rate increase. So yep, there's always pressure on earnings, no doubt about it.
I do want to talk to you about interest rates specifically. Obviously, they're on the way up. PFI's total mortgage, I guess you could say, last time I checked, is $800 million. You just refinanced with your BNZ facility, and now the average expiry across that is about 2.8 years. Yep. How much interest are you paying on that $800 million mortgage? Yeah, look, interest rates have moved up sharply over the last 12 months in particular. Obviously, after a period of very, very low interest rates. And so, our interest rate payments will be moving up in the near term. What we do to counter that, though, is we take on a series of hedges. We're 65% hedged against our debt, so we do have some good protection on that. And then if you overlay the current rental growth that we're experiencing in the market, we're in this constant game is probably the wrong word, but this series of events where we're trying to grow our rent greater than the interest costs. And as long as there's a gap there and it's growing, we should be able to continue to pay growing dividends to the shareholders, which is what we really target, growing dividends. Just quickly on debt still, your gearing ratio last time I checked is sitting at 28.5%. And I think that's pretty much average across the sector. But property as a whole, that to me, as I cover lots of businesses, is pretty high. Are you comfortable with where that is currently?
Yeah, I think the average is more about 32%, so we're at the lower end of the LVR or the gearing scenario. We're very comfortable there. It might seem high to an operating business, but to a property company where you've got a true asset backing, we've got 94 properties. So we like to think we've got a series of levers there, as if our gearing was to start to rise up, if valuations were to come back, we're in the market, we can sell assets to relieve a bit of that pressure. You can implement things like dividend reinvestment plans where you, instead of paying out cash to your shareholders, you issue them shares. So yeah, there's a series of levers there that gives us very, very good comfort, and 28% is historically quite low, so we're very comfortable with the current levels of gearing.
Given that interest rates are higher, and as you say, you're in this sort of game where you're always trying to play catch up to recoup those costs through higher rents, what's your outlook for your total shareholder return? I know that you have a pretty good history with an average annual return of 10% over the past 20 years, but given the environment that we're in, can that continue?
Well, again, the fact that we've been operating for in excess of 20 years gives us confidence that it is a long-term game. We're in the part of the cycle where it is tough to continue at that. But as we move out of this cycle, where valuations start to rise again, and you get ahead in terms of your rental growth, etc., well, then you'll make hay there. So, yeah, I mean, our share price to date this year, over the last 8 months has come up 6%. We're dividend returns about 4%, so we're sort of in line for it this year. But we tend to focus on that 5, 10, 15-year outlook. I mentioned earlier before we started the interview, we're working on a development at the moment with one of our tenants who's been a tenant of ours for 13 years. They've entered into a new 15-year lease with us. So we're talking a 30-year relationship with a business. So there will be ups and downs on the way through, but we're pretty confident at the moment where we're sitting as a business, yeah.
Now, Simon, I need to apologise to you because I may have potentially stolen your tagline without knowing it. So PFI has a tagline about putting investors' money to work. I always say at the end of my show, now go put your money to work. I promise it wasn't intentional, but perhaps good minds think alike.
Yeah.
But do you think it's now harder to put investor money to work given this high cost environment?
I think we're at a point of the cycle where there's a lack of transactions happening at the moment, which sort of reflects that current owners of property believe their property is worth a certain amount, and if they want to sell it, they've either got to be prepared to lower the price or potential purchasers have got to come up. And at the moment, that volume of transactions just not there. So we're probably treating water to a certain extent in terms of the industrial property market. So for us, we've got a real focus on internal projects. We've got close to $150 million of brownfield developments underway at the moment. So for the next couple of years, we're really focusing on getting those up and delivering them. Some great properties, 5-star sustainable buildings. So yeah, internally we're at a scale now, we're in excess of $2 billion where there's always a project, always something on to keep us going, sort of irrespective of the wider market. So it's a good place to be in.
I'll be interviewing a lot of executives over the next few weeks. So if there's a specific company that you want me to look into for you or question that you want me to ask them, let me know. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.